Every strategy works. This is the most common trading myth that every single trading guru has told you, and I'm here today to tell you that that is not true and it's completely false. And the reason you're not profitable is most likely not because of your psychology, but rather your strategy. Unlike most other gurus, I'm telling you straight from no filter, no BS, exactly why you're unprofitable. Today's video, I'm going to debunk basically the top 8 most common myths about trading. If you guys think about this, first of all, 90% of traders are unprofitable. Yet the majority of traders that are part of 90% are still the ones listening to what their favorite trading guru has to say, going through social media, browsing through top tickers, bottom tickers, however other people are trading, you're trying to copy them and it does not seem to be clicking or working whatsoever. Well, that's exactly why it's not working. You're not doing the opposite of what everyone else online, every trading influencer is preaching to you. These trading influencers with partnerships and affiliates with prop firms, you think they really want you to become profitable? Definitely not. Why? Because that's not good for prop firms. Prop firms don't really want to support a creator or influencer that's actually teaching a profitable strategy because they know they're going to lose money when they pay out their students. So let's go over these myths today. So first off, the first one I already talked about, every strategy works. This is completely false. If you guys go and backtest, a lot of the strategies from your popular trading gurus like Hasper SMC, someone recently did a backtest on his strategy and it was unprofitable for like 4 months straight, right? And then someone else also did a backtest on Phase SMC and his strategy was basically around break even. And there's no point ever in really trading a break even strategy because the point of day trading or trading in general, whether you swing trade, day trade, scalping, you're trying to beat the market. And when you beat the market in returns, that is called alpha. Okay, there's a difference between edge and alpha. Edge just means your trading strategy is profitable, but not by much. It can be a little, it could be a lot. That's edge. But truly, we want to be looking for alpha in our strategy because if you cannot beat the market returns of 10% annually on average per year, if you can't do that with your trading strategy, there's no point in you actively trading because it's a lot lower risk to just hold for a long-term investment portfolio and just at S&P, NQ, ES, all types of things, right? You can do TQQQ, QQQQ. There's sorts of leverage assets as well where you can actually make 30% annual returns yearly. So if your strategy is not really returning 10 to 30%, more than 10 to 30% per year annually, it's really not worth trading at all because factoring in human emotions, human mistakes, because you're the one mainly trading these, you're not even trading these algorithmically like most retail traders. We're hitting the sell and buy button by ourselves. It's not worth your time and effort and mental capacity and stress to be trading a manual strategy that cannot beat market returns passively. So go and backtest. Every time you guys find a strategy on YouTube, don't keep digging for different strategies. Find a strategy, learn it, try to master it, and then go straight to backtesting. If it does not work, switch to another strategy. I'm not a big fan of strategy hopping in a sense, but more so you need to give your strategy some sort of time first. And if it does not work, it just does not work. Not every strategy is going to have an edge. Personally, I truly believe from my testing that half the strategies at least minimum, so I can even say majority of strategies online on YouTube, TikTok, Twitter, Instagram, whatever your favorite trading guru is promoting, they don't work in a long run. Don't backtest and trade a strategy for 1 week or 1 month. You have to trade it for several months to a year. And that's when you can see true results of letting the sample size mean play out to its true definition, right? Because at the end of the day, you want to see a normal distribution curve. Because if you have a very small sample size, you will likely not get a normal distribution curve. And thus that means you won't actually know your true edge, whether or not your edge is even profitable, the mean value, the expected value, right? So next topic is you have to react to the market and not predict. This is another guru trading lesson that all of them talk about. This is completely false. Do you really think that you just have to react to the market to beat the market? Just use your common sense for a second. First off, I know it doesn't work because I've tried reacting to the market and not trying to predict it at all, and I kept losing, I kept failing. I didn't have an edge. My win rate could have been high, but my risk reward was awful. Or the risk reward was really good, but the win rate's like 10, 20%. If it was that easy that all you had to do was buy when price goes up and sell when price goes down, why are most people failing? Why are most traders failing? It's because that's not how the market moves. That's not how you actually develop an edge over the market. It's not as simple like binary ones and zeros when it comes to trading profitable. So no, you cannot just react to the market. You have to also have predictive models in hand. And what I mean by predictive models, I don't mean something that's robotic. It could be something manual, right? Your trading strategy should have some sorts of predictive forecasting behind each setup Because if you cannot predict where the price is going to go, where are you going to put your TP? If you're going to react to every single movement in price, you're going to fail as a trader. And I promise you, you can even try this in live trading. It's not going to work. You're going to lose money. Most strategies do not work. What makes you think that just reacting to the market by itself is going to work? When price goes up, you buy? No, that's not a strategy. That's gambling. So reacting to the market is purely gambling. I don't care if you have entry model or not. If you're just going to react to the market movement, it doesn't matter. You're going to not have an edge over a long run. You can tell me you have a green month, green week, but on a bigger picture, it's not going to come out green. Next topic is you should never backtest. So many trading gurus tell you guys, man, you should never backtest, go straight to live trading, don't even do demo trading. While I do agree demo trading does not involve emotions, I have a big contradicting opinion on this, and it's that you should backtest before you even get into demo trading. The reason why is because you need to prove that your strategy system that you're trading is not gambling, but rather it actually has some sort of edge. This ties back in to what I said previously about every strategy does not work. Stop believing these gurus when they tell you every strategy works. I'll tell you later exactly why they tell you this. There's a very big hidden secret behind why they tell you this, and it actually only benefits themselves. So let's move on to the next topic, right? Again, like I said, backtesting, you have to do it. Otherwise, you don't have the confidence when you live trade. If you don't have confidence when you live trade, you're going to have tons of psychology issues. And this ties into our next point here, which is psychology is the key to your trading profitability. This is another trading myth, man. Guys, focus on edge. If you want to even say alpha, go ahead, say alpha. But point is, you need something that's profitable over a long run that can beat the market. Psychology is not going to save a non-working strategy. The only reason why people kept on preaching psychology on YouTube is because they know their strategy does not work. So they want you to blame yourself for not being a profitable trader. How many of you guys here have tried a trading strategy from someone and you tried it for, let's say, 1,000 trades? I bet you a lot of you guys haven't even traded a system for 1,000 trades, first of all, or even backtested 1,000 trades. Let's say even like 500 trades. How many of you guys have truly stuck to a system with discipline, done everything you did correct, and the system came out either break even, a little bit in profit, which doesn't beat the market, or it just came out red? Because if that's you, this is 100% your personal experience with mine, right? Psychology is not going to save a profitable strategy. Not every strategy works. This is common sense, but people keep on thinking and banking on the premise that if every strategy works, then yes, psychology is your issue. But no, that's just not the case. Majority of strategies don't work. Psychology is the last line of defense, personally, in my opinion, when it comes to becoming a profitable trader. You need to make sure you have a mechanical, systematic edge. I am not a big fan of discretion, personally. I think sometimes people mix discretion with gambling, and they kind of do actually tie together. Discretion to me is almost like gambling. It's kind of like intuition based, okay? There's people that were trading for 5 to 10 years, guys, unprofitable. Some of you guys watching this might actually be one of those traders that are trading for 5, 10 years and you're still not profitable. I hate to tell you, but dude, your screen time is not helping you in trading. You don't have anything that you've actually backtested or tested. You need to put in smart work and not hard work in trading. This is not your typical 9 to 5 where you clock in, clock out, and you get paid. Everyone knows you don't get paid every single day guaranteed in trading. 80% of my days are green. 20% of my days I end red or break even. So I know statistically that I'm making money 80% of days and my green days are bigger than my red days. That's all I care about. As long as I can maintain that based on my trading strategy, which is what it provides, that is good enough for me. I'm not going to be able to make money every single day. But tell me, guys, man, psychology is the last line of defense. That's the last thing you should focus on when it comes to trading. That's the last skill you should master, per se. Make sure you have trade management, your entire system built. Make sure you backtested at least 500 to 1,000 trades, man. Some of you guys are not having robust systems, and when you go into drawdown in live markets, you question yourself and you tilt because you don't realize the strategy might not actually have a true edge in a long run, right? You can't just backtest something for a month like of data. That some trading strategies have green months and also red months, right? And they could be completely randomized too. It's not necessarily based on seasonality. So please go backtest. Make sure your trading strategy is profitable before you even move on to think about psychology. You're going to waste so much time. I wish I could get back all the time I wasted on psychology, but it's too late now, man. And I really do regret it. But it's a good thing everything paid off now, but it could have paid off for me much earlier. Instead of taking me over a year to become profitable, I could have became profitable much less than a year if I really stuck to what I teach now to all my students and the systems I've built and tested for you guys to implement, right? You guys don't even have to necessarily confirm that the strategy works. I still recommend and tell all my ETU students that you guys should still backtest the strategy once you learn and master the system, because it helps build your self-ego. I don't want to say the word ego, self-discipline and self-edge or self-confidence. And when you have a lot of self-confidence, you believe the strategy works. You've seen it firsthand with your eyes. So it's a lot easier to make less psychology mistakes and be a lot more disciplined and patient and waiting for those trades when you're trading in a live market. But if you just purely believe what I'd say and you don't do the testing yourself to build that confidence, it's going to be harder psychologically when you're live trading. So the main purpose of backtesting for you guys really is to ensure and make sure that you understand the strategy. Because if you understand strategy and trade my mechanical strategy properly, you will be green by the end of the month, by the end of the year, right? That's from my testing. That's from all my other students testing as well. So lock into that and make sure you are taking the correct valid setups that I've outlined in the course. Next topic is risk management is the key to trading probability. Oh, all right, let's get this over with, guys. Risk management is important. You obviously need to have almost perfect risk management in your trading, preferably. But look at this. You never know the sequence of your trading outcomes. Do you guys agree with me or not? Right? It could be L, 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 win, 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 win. Let's give this sequence here. You don't know if your edge is going to be first 3 losses or first 3 wins, or how many losses in a row, how many until the next win. So what risk management is all it is to me and to you is how much risk are you willing to put per trade. And there should be a percentage, not a monetary value, but a percentage of your entire balance or drawdown if you're on prop firms. Most people risk 1/10 of their drawdown on prop firms. If you're trading personal, I highly recommend risk only 1% or less. Unless you're on a very small account, sure, but I would not recommend you guys try to flip small accounts to big accounts. Take the proper route. Just have a decent sized account and trade with proper risk management and you'll be good. But why is this a myth, you may ask, even though I'm talking about risk management being good here? Well, the thing is, risk management is the key to trading psychology or trading probability is the same as when people say psychology is the key to trading probability. These two things literally are last lines of defense. These are the last things you should be learning or mastering, to be fair, when it comes to trading strategy. You always need to make sure you have an edge first. Without an edge, psychology is useless because you're executing something that doesn't work. Without an edge, risk management also useless because let's say you have a trading strategy at 40% at 1-to-1 risk reward. Let's say you have excellent risk management. You only risk 1% static every trade. Guess what happens, guys? You're still going to lose in your trading account at some point after a big sample size of trades. The only thing that this does here is it protects and smoothens out your equity curve. So if your strategy is profitable, it's going to smoothen out your equity curve so it looks a lot more stable. If your strategy is unprofitable, it's going to smoothen out your losses so your losing curve is a lot more smooth. But the point is you don't even want a losing curve in the first place. So there's no point in having a smooth losing curve. All this really does here is ensures that it takes longer for you to lose your account if you have a strategy that doesn't work, instead of blowing it on 2 trades, right? Instead of maybe having a profitable strategy and blowing it on 2 losses in a row. Like maybe if you full port or risk 50% of your account, you guys get the point, right? But basically if you risk half your account here, half account here, you're gonna blow the entire thing, essentially, after 2 losses, right? Not considering compounding in this case, just based on a static initial balance. And so risk management is not hard. Too many traders on YouTube are preaching this, and you guys are overcomplicating this. Risk management is just how much risk you're only put per trade, and how you determine this is using a Monte Carlo simulation. I have one in my Discord linked, so if you want to check out the free Discord, you should join that definitely, because I have a lot of free resources in there to help you guys determine which of these things you should focus on and not focus on to get you to profitability. But use the Monte Carlo simulator I have linked in my Discord, and that would tell you exactly what the risk management you should have, because you go off your backtesting data on your max potential losing streak, and then you determine your risk percent there. You don't determine risk percent and then develop an edge. You develop the edge first so you know your max losing streak, and then you determine your risk management there. One example here is like if you have a 90% win rate, you're going to have a lot less losers in a row. Your losing streak is a lot less than someone with a 30% win rate. And if this is the case, then someone with a 90% win rate, you can leverage your risk management based on trade size. So you can leverage having maybe 2 to 3 to 4% risk percent per trade because your losing streaks are so small, your drawdowns are very small. Versus if you're someone with a 30% win rate, like this guy below, even if your strategy is profitable, your drawdown streak, in terms of maximum losses in a row, at least, is going to be a lot bigger. It could be 6, 7, 8, 9, 10, right? And if you're risking 5% per trade, after 10 losses in a row, half your account's gone. And that's awful on a personal account. And on a prop firm, you get the point. That's not good, right? And so essentially, you need to determine your risk management based on your stats and metrics you get from your edge. So like something with a lower win rate, you're going to not have the leverage over your risk management. You cannot really over leverage much on a lower win rate. While in a high win rate system, you can leverage having higher risk to your advantage. So there's certain pros in having a higher win rate per se than just having high risk reward in this case. One more example when I talk about risk management, guys. Keep this in mind. For example, you would rather statistically have a trader that has a profitable edge in strategy but awful risk management than someone that has a very solid risk management, like basically perfect risk management. They always risk 1% per trade. They never under leverage or over leverage. They always risk 1% per trade, but their edge is non-existent or their strategy does not work because you're, again, like I said, you're just going to slowly bleed your account. Yes, it's better than blowing everything quickly, but we're trying to make money here, guys. I'd love to say protect your capital, but if you're trying to trade full time, you need income, and the income is coming from trading. So if you cannot grow your trading account to a green P&L by the end of the month, who's going to pay your bills? Not me. I'm not paying your bills. You're paying your own bills with trading, just like how I pay mine. And so what I'm saying to you guys is you gotta remember, risk management psychology, last lines of defense, right? A strategy with very bad risk management, for example, let's say this trader risks 1% on the first trade, then he risks 5% on the next, and he risks 2% on the third trade, and so on and so forth. You can see his risk management is all over the place. But guess what happens? This can be a very big pro and also very big con. So the con is if the 5%, if the trade, again, we don't know the order of our losses and winners, right? But if the trade that you took that you over leveraged on 5%, bad risk management, was a loss, you're going to take a big fat L on your account in terms of your equity curve. It's not going to be that smooth, right? It's gonna look something like this, and then boom, that's one trade down, already losing 5%. However, here's when it becomes a pro. If this 5%, the trade that you risk 5% on, was a winner, and let's say your risk reward average was 3, you know what happens here, guys? This 3 risk reward winner trade turns into a 15 risk to reward trade. I don't think you guys understand how massive a difference it is from 3 risk reward of your average winner to 15 on one trade. So you can see how this is a double-edged sword. Bad risk management is literally a double-edged sword. But the thing is, we don't want to be risking bad risk management nonetheless, because your equity curve is going to look very jagged like this. But guess what? Someone with an edge with bad risk management, your curve is going to look something probably maybe along this line, but it's going to be going up. It's going to be in an uptrend regardless. At the end of the day, your end P&L balance is going to be higher than your starting balance. But someone with best risk management, best psychology with an unprofitable strategy, it's going to look like this. You're just going to be at a negative 45-degree incline, essentially, instead of ideally a 45-degree incline is basically the best equity curve, right? Now, if you're compounding an account, it's going to be like this. You guys get that point. So let's move on to the next point here, though. Next point is you have to pay market tuition. Actually, before I get to the next point, just remember, I'm not here to preach that you should have bad risk management. I'm here to preach you edge first. All this is secondary, and that once you do develop an edge, you do want strict risk management. Make sure you're risking a static percent every single trade. Don't do what I just showed where you go 1%, 3%, 5%, because like I said, your equity curve is going to look very unstable. Yes, the odds are technically almost 50-50 in a sense. Well, not 50-50. It depends on your win rate. Like if you have a 90% win rate and you have your risk management all over the place, this can really carry your account a lot. But I'm not going to go into too much of the data behind that. I just want to basically say, keep your risk management static regardless. It's not hard at all. This is nothing complicated. The complicated and hardest part of trading, honestly, is developing that screen time to determine and find and develop a profitable trading strategy that works in all market conditions, or at least is adaptable, where you can switch it up and change certain factors or filters of the system to where it can adapt to different conditions and still come out either break even at worst, or at best, obviously green. Next is you have to pay market tuition. Guys, you do not have to pay market tuition. I'm sorry to tell you guys, but there's people probably out there on Reddit, on YouTube. Some of you guys even watching this. A lot of you guys that lost a ton of money trading, just like me in the beginning, or if you're still losing now after using years of no progress, thinking you're learning so much more, but you're not progressing, that's exactly why you're unprofitable. You're being taught you have to pay market tuition, and this is just completely false. Someone does not need to lose so much to the point where they hate losing to then fix their psychology. Paying more market tuition does not help you develop a better edge. You can develop a very good strategy edge through just backtesting. Okay? Because think about this. In the live market, what's the difference between backtesting and the live market? Emotions. Well, guess what? When you're developing a strategy, you should not care or even have emotions as a factor in your strategy. We're trying to, when you want to talk about edge and strategy, it's an objective variable. It's something that should not include anything subjective like your emotions. Because if it does, how can you determine a strategy works if you include your emotions into it? You can't, right? The equity curve is going to be all over the place because it's going to include human error and human mistakes. But in backtesting, there is none of that. It's pure objective results telling you in data in front of your face. This is what all my students in the ETU course and mentorship go through. I make all of them backtest 500 to 1,000 trades. Until you do that, I don't want you to go live trading because I know once you develop this edge and confidence, you don't have to lose money anymore in the markets. You can immediately start having green days and green months on your first day live trading, right? Now, if it's your first time ever live trading, that's a different situation. You have to get comfortable with how to execute trades, how to place your stop loss. But most of that beginner stuff within the first few weeks, it's pretty straightforward. Nonetheless, you do not have to pay market tuition. Don't listen to gurus that keep telling you that you have to lose a lot to gain a lot. What these gurus are trying to do, I'm gonna tell you guys the straight facts, is they say these three things. So number one, they blame psychology and say psychology is key to you because they're gonna sell you a course and mentorship teaching strategy that does not work. And they're gonna become millionaires selling this course while you guys keep losing money. And this becomes a funnel for them. So since they're preaching that psychology is the key to trading probability and telling you guys this is the holy grail, now a lot of you guys are deviating your problems from the strategy and you're trying to blame yourself. They're basically trying to make you blame yourself for being unprofitable, when in reality, the person selling you the strategy is the person to blame. Okay? Then, if you cannot follow the strategy properly because your psychology, emotions, then yes, I do agree. Psychology is actually your issue. But until then, you always look for the edge and strategy first as the first number one factor. And when it comes to trading probability, right? A gambler with the best psychology doesn't mean anything. Those two things don't even make any sense. So that's why they preach you and sell you so hard on psychology. Another thing is, if psychology truly was the holy grail and the golden nugget to trading probability, how come you guys are still buying training courses and mentorships? Just a real question to you guys. Think about this. Why are you guys still buying training courses and mentorships if psychology is actually the reason most traders fail? If 9% of retail traders are unprofitable because of psychology, that's the premise. Why are you buying training courses? You're not lacking knowledge from that standpoint. From that point of view, you're actually lacking emotional control, which is not something that can be taught. Discipline is not something you can be taught. That's the same as telling a fat person, go work out, go do some weight. I can say all the psychology tips and tricks to you guys here, but it's not going to change until you decide to be disciplined yourself and take action and be accountable for your mistakes that you're making. So just keep this in mind, guys. You should not be blaming yourself. Always blame the strategy. Don't blame the strategy. Look into the strategy first. Test it first. That's why I tell all my students, backtest. It's a lot more useful to backtest for 3 months than to live trade ever for 3 months. Because when it comes to live trading, you're just repeating what you did in backtesting. That's how I view live trading. And that's why I've been consistently profitable for the past years. Because I put in the work to backtest over 4,000 trades of my refined, developed edge. I teach you guys all in the course mentorship now that you guys are currently learning from. And you just have to apply that and practice. Once you practice, you can go straight into making money. You skip all this BS here. All this BS you're skipping essentially, right? You don't not need to lose any more money, okay? If you find a strategy and you follow it to the T and you're still losing a ton of money, the strategy just does not work. At some point, you have to accept this is false, okay? And I'm telling you guys right now, from a lot of my testing, a lot of strategies just don't not work. They just do not work. This is why there's a difference between me and the other training gurus, because I sell you guys something that generally works, that has proven objective data behind it, proving that it works. It's not something subjective. It's not a discretionary strategy. It's a mechanical strategy, so you can replicate it on your end. It's not a trading robot, unfortunately, because that's a whole different story. Code and mechanical stuff is still a separate situation. But in the future, I'm sure as coding becomes a lot more complex and AI becomes better, I'm sure at some point we'll be able to train AI models to trade my strategy. But for now, we're mainly trading in the ETU group. And that's completely fine because I'm not spending too much time trading every day, 1 to 3 hours in your session, make my money, call it a day. And then if I want to trade a session, I can trade a session. That's it. Nothing too crazy. So next here. Oh, also this, the paid market tuition. Guys, the reason why gurus preach this so much here is because they want you to keep paying for stuff. The whole trading industry is like a circle. It's like a loop to get you stuck in this unprofitable cycle forever. This is why I like tell you guys, a lot of you guys are unprofitable. You guys are stuck, the ones stuck on the internet looking up stuff all the time, right? And this is going to be the last video you probably watch. I hope this is the last video you watch. And then you go actually find deeply, either from your own testing, from your own personal experience, and develop a system, or learn mine and just replicate it and make money off the bat. There's not much you have to do there. Just please stop staying on the internet forever. You're gonna end up brainwashing yourself with all this into your brain, and there's no return from there, because these gurus tell you have to pay market tuition so you trade longer. And so you think that time equates to profitability. I forgot to add that as a note here, but time does not equate to profitability whatsoever. There's people that are unprofitable 5 years, there's people unprofitable 10 years, and there's people that are profitable already only after 1 to 2 years. And matter of fact, I have a few students in the private mentorship that have been profitable. They were unprofitable for 3 years. Most of them were from 1 to 3 years. We do have a few people that are probably a little bit newer, I'd say on the end, only a few months, but most people are 1 to 3 years in that join the mentorship, and they become profitable within the first 2 months because they've done their backtesting, they put in the work, the correct work. I'm not even talking about time. They didn't put in a ton of time. It's not the time that's the issue. It's what you're actually doing with that time. It's quality over quantity always in trading. So yeah, these gurus want you to keep paying for this stuff, and they have these leads to sell you more and more stuff. And that's why this is the biggest trading guru myth. That's why every other trading guru is teaching you guys all this stuff. I'm teaching you guys the complete opposite of everything they're teaching you, because again, I don't rely on my sales or mentorship course sales to make a living. They do. So that's why they all understand this, and they all have to preach all this. Otherwise, they're going to get a lot less sales. People are not going to stay for long. They're going to get a lot of bad reviews. Next, you need at least 3 to 5 years to become profitable. This, like I said, ties into the time thing. Time is not the factor that leads to profitability. It's the quality work that you're putting in, not the time. Good quality information, quality work. If you're interested in that, you already know where to go. But time is not a major factor when it comes to trading. Of course, you're not going to become profitable tomorrow or today if you're brand new. Give it some time, but make sure you're not spending more than 3 to 5 years, please. If you're spending more than 3 to 5 years, you're either making the same exact mistakes or you're just doing something completely wrong, and you need to DM me and I'll try to see if I can give you any free advice on that. The last but not least, guys, you have to develop discretion through screen time and intuition to become profitable. Again, this is not me saying it. This is a common guru myth. All the gurus are telling you guys, discretion. Discretion is how you become profitable. Screen time is how you become profitable. This ties into the time thing too. Intuition is how you become profitable. I'm here to tell you this is complete utter BS. Do you think hedge funds where they have manual traders, so you guys know 80% of trading volume is algorithmic, but that other 20% also comes from retail traders as manual traders, and hedge funds also do have manual traders clicking buy or sell manually as well. Do you really think they are telling their traders and giving them psychology workshops? Most likely not, right? They're just employing strategies manually. That's all it is. They have an edge already. They're just basically sitting there and waiting patiently to execute that edge. So keep in mind, if you really think these big players are trading through discretion, good luck to you, because that's when you get stuck in this loop of 10 plus years of unprofitability. Because what if at the end, worst case scenario, what if I told you and you later find out discretion is not a real thing in trading that actually works? Then you just wasted so much time of your life, and I don't want you guys to go through that hole, because I would have gone through the same exact hole if I still today did not develop something mechanical that I can backtest. You cannot really backtest discretion too much, right? That's why I like to use candlesticks. That's why I like to use price action, things that can mechanically identify through the candles, a setup or a strategy or entry or exit or a stop loss or a TP or how I manage my trade. I don't like to gamble. Intuition, in my personal opinion, I used to believe, like you guys, that it is a major factor in profitability, but I later realized most of intuition, discretion, and screen time, these three words are basically kind of mean, I'd say almost the same thing, and it's no different than gambling. Because guess what a gambler says? A gambler says, I feel like the market's going to go up. A lot of you guys that are trading off just discretion or intuition, you are always feeling something. You guys see where I'm going with this? When you say feeling, that's directly emotion. That's emotional related, emotion-based decision making. That's not something mechanical that a robot would ever do. A robot has no discretion. It has no intuition. It has no screen time. Okay? It's just trading by a set of rules. And that's what I preach to you guys. Always have a system. Have a strategy and a set of rules. Strategy plus a set of rules equals a system. And backtest that with a good sample size of 500 to 1,000. Trade it in the live market with being disciplined, and you will be profitable. That's the shortcut there. Hope you guys did enjoy today's video of the top 8 most common myths about trading debunked. If you guys really enjoyed this video, found it very valuable, make sure to subscribe. Hit the notification bell because I do stream around maybe like once a week at times here and there. So if you don't want to miss those streams, man, definitely check out the channel. And also, last but not least, join the free Discord server. Link is down below and on my website. And if you truly are interested in investing in your future in trading education and you want to become profitable in 2 months, join the mentorship and the course, and I'll see you guys in there. Peace.